Hello and welcome. This is KYC, a show designed to give regular investors powerful, actionable insights into fundamentals of a single NSE-listed company every day. Today, we're talking about a very interesting company from the technology space, Oracle Financial Services. And it's actually had a very strong 2024, of course, before we saw the correction in the broader markets, and that's also led to a little bit of precipitation in this stock as well. However, it does seem, with the way things are going, the prospects of the company seem strong. Yet, let's address how things could potentially pan out for the company. But before I do that, I want to tell you what this company does. So, it does offer software for retail and corporate banking. It's largely related to the financial system, and that's where it focuses its software on. So it also offers software on risk and finance, financial crime and compliance management as well. And along with that, of course, it also provides the IT infrastructure management services. Moreover, it also does have business processing services. So BPOs are a part of the business, and it also provides consulting services along with the entire life cycle of applications used by financial institutions. So as you can see, it's essentially a company which has been veered towards addressing a lot of the needs of the financial services sector in general, and well, that's what it's been doing. At the moment, however, it's not so much about services as much as it's about products, because in fact, as for the FY24 revenues, 91% of its revenues did in fact come from products, and only about 9% came from services, which is why this is a very unique technology company where it's not so focused towards services as much as it's focused to financial services products. But we'll talk about that in a little more detail. What we usually do with all the companies, as usual, well, we talk about the fundamentals of the company, and this would include how the company is done in terms of its revenue, in terms of profitability, what kind of margins it throws up. And beyond that, we look at the balance sheet, the cash flows, and of course the return ratios. Moving beyond, we also take a look at the shareholding, street credentials, street coverage, and valuation. And these are some of the basics that we cover for every KYC in the company. On that note, let me also welcome in Rucha, who's going to also help us further elucidate how the company has done as far as this particular, stock is concerned. So Rucha, welcome to the show and thank you for joining us. Let's, as usual, start off with your top line, bottom line, and the profitability. How has this particular company done?
So I'll start with the income statement check. As you rightly mentioned, revenue came in at about 6,373 crore rupees in FY24. This actually pointed out to a 3-year CAGR, that is compounded annual growth rate of about 8.5%. EBIT stands at around 2,680, and 3-year CAGR again stands at 4.6, as you can see on your screens. Net profit at 2,219 crore rupees at about 8% CAGR. So though the numbers are good enough, in terms of the 3-year CAGR, this is a slightly mid-single-digit growth over a 3-year, which is not really that much interesting. So that is why we've given this one a thumbs down. And just for clarity, the large two segments in the revenue consists of products and services, products of which consist around 91% of the revenue.
Right. So it's not been an amazing kind of growth, especially for the size, Oracle Financial Services is. It's not exactly a large cap company. We do know that. And, when it comes to its growth over the last few years, it's not been satisfactory. In fact, for a 66,000 market cap company, there are a lot of companies out there which have at least a double-digit growth, going forward. But that's not turned out for revenues and profitability, which is why we'll give this a thumbs down. However, there are plenty of factors to suggest that things could potentially be turning for Oracle Financial Services. And I just want to point out that the first 9 months of this particular financial year have been very strong for the company. A lot stronger as compared to what we've seen in terms of the 3-year CAGR. So that's something that we need to bear in mind. But let's move on and talk about the balance sheet. Well, this is a tech company. Look, so it's going to be a strong balance sheet. Of course, I'm not talking about the shareholders' equity. We should actually be taking the net worth, but it's a debt-free company. And it has cash worth 4,700 crores on the books. So, well, very sorted. So it's going to be a thumbs up as far as the balance sheet is concerned. Now, moving on as well, I reckon that some of these particulars could see further improvement going on. But Rucha, how are cash flows looking at?
This one is a neutral rating over here because the cash flow conversion is not that great, below 100%, wherein in general, most IT companies have more than 100% of cash flow generation because largely most of them are debt-free over here and high cash rich. The CFO in terms of numbers stands at about 1,791 crore rupees, as you can see. So largely as on FY24, largely it has remained around the 1,700 to 1,850 kind of levels, but the conversion, as I mentioned over here, stands between 65% to 75%, which is not a great number, but also not that bad to give this one a thumbs down. That is why we've given this one a neutral.
Right, so fair enough. Well, I guess that it's essentially comes down to EBIT, which is curtailing the rating for particular cash flows.
Actually, this is the conversion ratio.
This is the conversion ratio, right? The conversion ratio, of course, being not as good as some of the other tech companies, because from what Rucha tells me, that some of these companies are about 100% conversion ratio, and hence, a little bit of a challenge there. But that said, let's take a look at your return ratios. Now, look, this is a tech company, so the return ratios are going to be superior. There's no doubt about that. So your return on capital employed comes in at around 40% in FY24. And it's improved over FY22 and FY23. So naturally, a thumbs up there. If we just move on and talk about the shareholding pattern, how does this one look?
So largely, around 73% of the shareholding stands in with the promoters. So kind of good hold over the company. Though the free float stands at around 25%, but still, this one is a thumbs up because it's largely less volatile in nature. In terms of the institutional holdings, FIDIS is a largely equal kind of weighting, 8.5 and 9.5, and the other stands at around 9.5. So largely good hold on the company, less volatile stock over here, hence this one is a thumbs up.
Okay, so thumbs up as far as shareholding is concerned. I just want to point out if there are some, important investors in Oracle Financial Services. And, as I was mentioning, that it has a market cap around 66,000 crores, which means there will be a lot of institutions who will, in fact, be invested in the company. So firstly, we have Life Insurance Corporation, which has about a near 2% stake. Kotak Mahindra, AMC, HDFC AMC also have stake, along with, of course, Motilal Oswal. It's actually a part of the Motilal Oswal Momentum Index as well, and rightly so, because, like I said, 2024 was a very, very good year for OFSS. So these are some of the names, that are invested in this particular company. But moving on, even if consider the FIIs, they have about 8.5% stake. And in terms of FIIs, we have another entity called Wessex, which is also in a part of the shareholding. But in general, overall, this is how things are looking as far as their shareholding is concerned. I'll move on and talk about the street credentials. And as far as street credentials are concerned, in the last 6 months, where we are looking at 26% returns, or rather, pardon me, this negative 26% returns. And of course, in the last 12 months, looking at returns of around 5.8% at the moment. So keeping an eye on some of these factors as well, they're clearly underperformed. So that's as far as your street credentials are concerned. Rucha, why don't you, take up the street coverage as well as valuations? How are these aspects looking here?
So as you rightly mentioned, returns are not that great, but in terms of street coverage, there is only Dolat Capital, which is covering this stock and has a target price of about 11,400. Therefore, implies return potential of about 41% over here. So definitely a neutral rating, not a thumbs down or a thumbs up, because not much of a coverage that OFSS has on the street. In terms of valuations, this one stands about 26 to 27 times its FY26 EPS, and this one is actually cheaper than its other peers like Happiest Minds, Emphasis, Coforge. So other than Coforge, these two names trade at about 30 to 33 times its FY26, and Coforge stands at around 40 times FY26 EPS. This was because Coforge run a lot in the last year, but OFSS since the last 3 months have come down because of its bad earnings, and that is why that kind of stock price correction has happened, and which is reflected in the valuations as well over here. So even Dolat Capital says that the third quarter was not really good, but the prospects in the fourth quarter seems to be fine from the company.
Okay, well, there you have it. That's, Oracle Financial Services. So that brings us to your overall rating, and we can take a look at how things are panning here. So, firstly, when you take a look at, your, your income statement, that of course is a decline, but balance sheet looking good, cash flows and return ratios also looking good. And moving on, we also have street credentials and street coverage along with street valuations up. Street cred, however, is down because it has lost a little bit of in terms of price action, and has also underperformed the market. But remember that when you are a part of the momentum portfolios, when you do in fact do see a correction, you also tend to see that much more correction in some of your momentum-based stocks. And considering the fact that Oracle Financial Services was one of them, where we are looking at that weakness as far as price action is concerned. So that brings us to an overall rating of 5 out of 8 on this particular company. But want to move on and talk about a handful of other aspects here. And if we can actually revisit what's happened in the third quarter, particularly, Rucha, if you could actually quickly take us through these numbers here.
Yeah, so as I mentioned, third quarter was bad for the company. The revenue was up just modestly by 2.5%. Margin was down on a quarter-on-quarter basis, down by 5%, and even the margin in percentage terms came in at about 41% versus 44% last quarter. Net profit was down about 6%, and this was largely because of delay in milestone completion by the company. But Dolat Capital, which is the only brokerage house that covers this company, mentions that this actually will bounce back in the fourth quarter, or is expected to bounce back in the fourth quarter, and a recovery in the implementation, which actually affected the third quarter, might be one of the key levers for growth in the fourth quarter. Apart from that, the ongoing license wins could also ensure visibility in the coming financial year, and therefore they have given this one an accumulate rating and a target price of 11,400. Mind you, Oracle was one of the top outperformers in CY24. But because of the underperformance of the share price in last 3 months, the overall return over the last 6 months have come down by around 26%, as Agam had covered in street credentials over here. So disappointing third quarter, but Dolat Capital expects a recovery to come in from the fourth quarter.
Okay, well, actually, we do in fact have Rahul Jain. He's a director of research at Dolat Capital, who joins us to take us through what he actually, further elucidate what he makes of Oracle Financial Services. So, Rahul, firstly, good morning, and thank you so much for joining in. Since we were talking about this particular company, what we've seen is the growth has been lackluster, at least over the last 3 odd years. But we also saw a significant pickup in the share price of the company, which means that at least investors to a certain extent were expecting prospects to improve considerably. So my question then is that what are you making of this particular company at this point in time?
Yeah. Hi. So basically, if you look at a growth rate in FY24 and to whatever degree we have for the 3 quarter, the growth rate has actually improved meaningfully from 4 to 5% CAGR the company used to do prior to these years. And this company basically is a product business, so there is a lead indicator in form of the license fees, which is a typical lead indicator for any product business. That part of the revenue segment has shown incredible growth in FY24 second half. And ever since, the stock has actually got elevated because the growth were pretty significant in Q3 of last year. So basically, all this change in the growth matrix, both on the revenue basis as well as on the lead indicator basis, led to re-rating of the stock, and that's why we saw a significant up move. Of course, now we are seeing a bit pain in terms of PE for the mid-tier and also larger stocks, so it is taking that kind of a hit as well. However, having said that, since the growth rate for this business is improving versus what it used to see in the past, we are confident that the company should be performing better compared to other peers in the mid-tier space. That's our thought right now.
So Rahul, I actually want you to elaborate a little bit more when it comes to the company being a product business and how the licensing works in this case. So what does that mean for registering revenues? If you could, further elucidate, because this, of course, is not your usual, technology company which is listed on the Indian exchanges. The business model here is slightly different. If you could explain to our viewers how this particular aspect works here.
Right. So for any software business, the typical model is you sell the license, which is the first piece of revenue that gets recognized in your P&L, and then it follows up with the implementation of those licenses, which take typically two, 3 quarters of rollout, depending on how big the bank is, how many geographies it is spread into. And then the third element is the AMC, which is the annuity revenue, which you see on an annual basis. So this is the typical revenue model, and that's why I was talking about that matrix look healthy, which led to re-rating, because the license revenue for last fiscal was around 135 million versus a typical average around $90 million the company used to do prior to that. So it was a good 30-40% jump on that number, which basically led to re-rating of the stock. So that was where it started. And just one more point to add here is that this is a very high profitability business, which also supported the momentum here, because the profitability further improved to upwards of 45%. And that is where the incremental comfort comes in. And this kind of a business do not have any capex, so there's a lot of cash flow which get generated in the process, and all of it get distributed. If you look at their payout history for last 8-9 years, whatever cash flow they have generated, they've paid out 100% of that. So some of those things were also adding up to the re-rating thought process.
Well, okay, one question from my side over here. As you mentioned that the prospects look good and all of that, but IT as a general the sentiment seems to be down in the coming quarter as well, Rahul. And how different can OFSS be? Because in your note, you've mentioned that you expect a recovery in the fourth quarter and in FY26 as well. So can you explain to us what could actually be, beneficial for OFSS, and how can it be resistant to what is going on for the industry as a whole, IT industry as a whole?
Yeah, so of course, very broader aspect like any let's say US GDP or any developed market GDP, of course, is an important parameter and would also have its bearing on Oracle, just like any other IT services business. But here the bigger story lies that is banking segment in the Western world is he going to go for a big modernization. So that is the theme out here. In fact, as I was mentioning, that last year license signing was pretty strong. So one of the biggest factor was there was one market deal where they saw a very large bank moving from mainframe ecosystem to cloud deployment. I think this is a very big change that is shaping up. It may take some time, but if that plays out well, there are so many large banks which are very outdated on tech in the Western world. And if they move to the cloud, which is the big drive factor, I think Oracle could see a much better growth in next 10 years versus what it saw in last 10 years. And that's why I won't align it to the broader IT services business, because the business model and driving force are very different out here.
Business model is different, I understand. But talk to us more about the licensing part. Was only missing the milestone a problem in 3Q, and because of that the stock corrected almost 25% since the earnings. So I'm not able to do the maths over here, and what will happen suddenly that could poise to a recovery in the fourth quarter?
Yeah, so I would say one more uniqueness of this business versus, let's say, a services business is that the license win happen or get reported on a quarterly basis. And the repeat revenue nature in this kind of a business is as low as 45-50% versus 85-90% in case of IT services. And that is why there could be a lot of quarterly volatility that can happen. As I also said, there is more and more demand which is happening on the cloud side. the recognition of the revenue kinds of get deferred, but that adds up to the visibility into the future. So I'm not very worried about one specific quarter not doing well. Of course, the reaction is sharper with market as well as Q3 being weak. But we are sure that as it is going to continue to trend better on the growth path, the stock should ideally outperform the other mid-tier IT services space. That's our thought at this point.
Now that we have you with us, in general, if you leave OFSS aside, how are you rating the tech sector at the moment? I know that there's been a lot of rhetorics from the President of the United States that said, well, we have a lot of uncertainty with respect to the interest rate trajectory as well, which also has a lot of leaning for the financial sector as a whole. Which of course indirectly means what that indirectly means to the business for Indian technology companies. So your overall view of the Indian tech space at the moment, what are you making of it?
Yeah, I would highlight 2 3 things that forms our base opinion. So we were neutral to negative on the services space for some time, and these were a slide coming from the fact that the growth rate which we are anticipating versus what kind of P multiple these businesses were trading were slightly stretched, and that's what it required some kind of a correction which is underway right now. So we would possibly start liking some of this name post this correction. But prior to that, we were very selective in terms of what kind of valuation we were comfortable. So we were having more sales than buy in our rating thing. The current view, which you are saying that how things are shaping under new administration, what we are seeing from an incremental perspective, I think my real worry point would be if the US GDP growth has to further deteriorate from here. That would definitely have a negative bearing on it. But outside of that, I just believe that the growth rate may not be as bad. And thus, we don't see a meaningful de-rating kind of a risk in the business.
Okay, on the services side, I understand, but let me talk to you more about the top tier companies. Infosys, TCS have corrected a lot bit from what they had hit in CY24. So what's your outlook on the top tier companies, especially the likes of Infi, TCS, HCL Technologies and LTM IT? Well, not TechM because it's largely more of the communication side, but on these 3 names.
Yeah, here also, if we see go by the consensus estimate and our estimate is slightly lower than that, the street is building closer to 7 to 9% kind of a growth going into next fiscal. With the kind of economic data and disruption that we are observing, and also there is uncertainty, I think the guidance that we will hear from likes of Infosys, HCL Tech, who gives explicit guidance, if those numbers range around 5% or 6%, it will further lead to some de-rating or at least some cut in the estimate. So that would be the decisive factor going forward. We see there is a small risk of estimate cut that may happen in the month of April as these results will come in. And probably that is the time we would have the revised thought process and estimates accordingly. So those are the thought process. We think there could be some pain till April, and absolute correction we don't see much, but some bit of pain may come in the mindset given the fact that there could be some estimate cut that may happen in Q4 as well.
Okay. One last question from my side. Forget about the quarterly returns. I want to know what kind of returns are you expecting IT to give in FY26 as a whole? Do you think recovery could be expected in the second half?
I would say at least in large cap where we are thinking a rupee basis, 9 to 10% growth can happen along with 2 to 3% dividend yield. So basically, once we see the bottoming here in probably around month of April and May post the new guidance get reset, some upside potential can happen because we don't see them to be crashing significantly in terms of growth thought process. Neither from a valuation perspective, they were always pretty reasonable. So this 15 odd percent of correction there has brought them into the zone where they can trend. So
Okay.
if we
Okay.
expect 7% growth to continue, 20 to 24 multiple which they are trading today can sustain, and that's why 10-12% return is
Let me.
possible.
Okay, Rahul, one last question again because I'm very much curious. So, do you think that the bottom is still not here for the top tier IT companies? Because I heard you mention that the bottom might come in April and not now.
So I was more mentioning from a growth point of view because we would get that guidance, explicit guidance in the month of April, not from stock perspective. Let's assume they talk about 6-7% growth, then our current estimate will stay hold at that level, and that's why the upside could be even better. But let's assume they have a slightly cautious view and they guide for, let's say, 4 to 6% kind of a growth. So we will do a small reset on our current estimate, and on basis that we may probably ascribe a more reasonable multiple than what it is trading now. And that's why I was saying April become a decisive point. So nevertheless, I think 5% as a bear case and 10-12% as a bull case is what you can think about as a for the top three IT names.
Okay, well, Rahul, point taken. Want to thank you for joining us and giving us that very comprehensive view on not just Oracle Financial Services, but also the entire financial service, pardon me, well, technology space at the moment, which of course is looking at a lot of volatility for many reasons that Rahul has already mentioned to us. But on that note, it's a wrap on this edition of KYC, but stay tuned in. We'll be back in just a bit. We have lots more lined up. You're watching NDTV Profit.